And if I want to ask the question, what's the net operating income after tax? Well, think about it from the two aspects. If I earn another $1,000 income beyond the $50,000, and let's say it doesn't cost me anything more, well, what's left over for me? Well, I've got $51,000, my deductions stay at 30, taxable income goes up 21, and the government wants 40% of that. Right? So just like the government's helping me pay for stuff, anytime I earn $1, the government takes 40 cents away. Okay? So if I'm looking at this formula, and I want to say, well, what is the after-tax cash flow, ATCF, after-tax cash flow? Well, our revenues are cash, and here we're identifying the cash expenses. Right? We'll worry about depreciation and capital assets later. So think of this as cash. Cash is coming in, cash is being spent. What's the cash left over for the shareholders? Because that's what we want to do in our financial analysis. Well, if I make $1 and only 60 cents is left over, then this part really is 1 minus T. Okay, and hopefully you agree that 1 minus T against the expenses is my actual after-tax cost. So, maybe to make it less confusing, if I do this, revenue, 1 minus T, right? Make $1,000, 600 left. Okay. Spend $1,000, it's only really costing me 600. Okay. And so if I put them together, I get this expression: revenue minus expenses, which is my net before tax cash flow. So this is the before tax. This is what's left over after tax. So the after tax cash flow stuff. Okay. So when we're looking at our project analysis, we're going to look at the revenues, we're going to look at the cash expenses, and that's what's left over. Okay. And again, it's just based on this. What's the after tax income? Okay. So this is sort of the easy part. And virtually everything we get, everything that we spend, earn income, we get to deduct. It is an expense item. Treat it this way. Except, of course, if we buy a piece of equipment, and that equipment we're going to use for a number of years, and it's providing a service, or we're manufacturing with it, then it is a capital asset. And the government says, well, that capital asset is going to benefit your company for a number of years, therefore you can't write it off and get all the tax savings right away. Let's look at the period of time that it's in the company, and let's flow out those tax savings as the equipment loses value. That's what depreciation is all about. So if I go down the capital asset route here, so I'm going to spend $1,000 on a piece of equipment, I'm going to have to consider it from 2 points of view. This point of view, and here I'm going to break the tree out into a long period of time. Long-term asset. So in other words, I'm going to keep it indefinitely. What does that mean? Well, 8 years, 10 years, 20 years, whatever. It depends actually on the depreciation rate. And you'll get a sense of that when you look at that. So if I'm now looking at keeping it for a very long time, let's ask the question, what's the total tax savings associated with keeping this asset for a long period of time, i.e. from 1 through infinity? And then we'll back off and say, well, what's the difference between 1 and 10? Well, what do we need to do? Well, we need to depreciate it, and we'll do that each year, and so that's what the schedule is about. So if I go down this part of the tree, and let's say I want to explicitly calculate the depreciation. Well, in Canada we do CCA with a half-year road. Right? So what we need to do is calculate the depreciation tax savings, and I have a first cost, the cost of my asset, in this case $1,000. So in the first year, D1 is going to be first cost divided by 2, that's your half-year rule, times little p, where little p is your CCA depreciation rate. Okay, well, here, little p is 30%. FC is 1,000, and therefore 500 times 30% is 150. And in any year, the tax savings, DTS, in any year, K, is simply T times DK. Okay, so that's the guy up there, $60. But since I have to wait a year, I'm building a cash flow diagram now. So I'm buying it end of year 0. And in the first year, I get to take D1 And if I'm paying taxes, then I get $60 worth of savings. What's that worth today? Well, that's your fee given that back. Okay, so that first depreciation, tax savings, is worth $52 today. Okay. Now, year two, it becomes basically a standard declining balance. Okay, there's no more half-year rule. So what do I have? Well, I've got FC. I've taken D1. So this is known as book value, DD1, right? What's left over after my depreciation, I've only taken one. And D2 then is that. DPS2 is then T times D2. Okay. So essentially book value, so this guy here, 1,000 minus the 150 that I took in year one leaves me 850. 30% of that is 255. The tax savings, 40% is basically whatever, 102. So I wait a year, right? Because I'm taking depreciation out of year two. Okay, and what is that worth now? Well, you could have 15% on it. And as I continue to do that, so now all I'm saying is really, I guess D3 is going to be DV2, or in general terms, K minus 1 times P. That's declining balance. So it's declining balance with this minor modification for year one. This is your half year. So what do I see here? I see that if I buy this asset, the present value of the tax savings is $249. If I keep it a long time. So what's my after-tax cost? Well, if it costs me $1,000, and the value of all of these tax savings is $249, then whatever that is, $751. So we're going to say the after-tax cost of this $1,000 is $751 after tax. Right? Yeah, I spend $1,000, but I get $249 worth of tax savings if I keep it a long time. Okay. This is what we call the capital cost tax factor. Now, of course, we never keep things for infinity, but look at the error that's introduced by this simple model if I keep it for 10 years. Well, the depreciation from years 11 out to infinity don't really amount to very much, right? $2 present value. So this is a good enough model. Let's say if I'm keeping this thing for 10 years, 247 is close enough to 249, not to worry about. Okay. So if I have an asset that I'm keeping for a very long period of time, I can use this method here, and I've got a closed form for it, which I'll show you in a second. So I think this just summarizes what I've said. Why do I always want to deduct something if I can? And I'm going to show you an area where, an example where it's a gray area, where you can do it one way or another depending on how you play the game. Well, if I deduct it right now, it's going to cost me $600, right? Because I get $400 worth of immediate tax savings. The government forces me to depreciate it. I got to wait for those tax savings. Well, time value of money is working for the government, not me, and therefore it costs me more, $17. Right? And the lower the depreciation rate, the longer I have to wait, the more it's going to cost me. So that's the big one. And so the tax savings arise because we're making a profit, i.e., revenue minus expenses, 1 minus T, is greater than 0. In other words, I'm paying tax. So I'm reducing those taxes. Okay. And if I look at this, this is how a standard capital cost allowance works. Note that year 2 is always the largest when the half-year rule basically kicks out. Okay. The other point I want to make is these are tax savings, and very specifically use those words, because if I'm not paying tax, I can't save, and therefore depreciation has no value. So if I want to modify this for, let's say, a company that's not making me any money for the first couple of years, well, I'm going to do this. Year 1, they're not making any money. Therefore, they're not paying any taxes. Therefore, they can't save on depreciation. Simple. But what happens to book value? Well, nothing, because I haven't taken any depreciation. So book value 1 is 1,000. Now, book value 2 will be 1,000 as well, if you go back to this formula, because I haven't taken any depreciation. Right? because I'm not making any money. So I'm not profitable here. Now here in year 3, I start making money, and therefore all of a sudden depreciation is worthwhile because I'm paying taxes. So we'll then have depreciation tax savings. And they will be based on a book value of 1,000. Right, the half-year rule has expired because it's only in the first year. So this charge here, which will be D3, will simply be 1,000 times 30%. Right. Of course, the cost of the asset has gone up because I have to wait for these savings. Right, so it's going to cost more than the $751 per after tax. It's like a company, like the government kicks a company while it's down, right? If they're not making any money and they acquire capital assets to get out of the hole, well, the capital assets are going to cost more because depreciation is not valuable while they're not profitable. Okay, so essentially, just remember that these are tax savings. Now, that chart that I showed you, you don't want to do that line by line. And so if you're keeping an asset for a very long period of time, this is a very good approximation to the tax savings. It's called the capital cost tax factor, and it's just a closed form for figuring out what are the tax savings. Well, actually, one minus the tax savings. Okay. And so what do I need to know? Well, I need to know the tax rate. I need to know the depreciation rate and my time value money. And that will tell me exactly what the cost is going to be. The first formula is in the textbook and doesn't take into account the half-year rule. Even though the textbook was modified in the year 2000, I guess Professor Penn didn't know about it, he didn't modify it. Maybe he wasn't up on his taxes, because this thing changed in the 1990s. This is the real formula, okay, and it's probably not a bad idea to jot that in your textbook, you don't need it. And this gets us to the 751 we were talking about. What this says is, for every dollar that I spend, it's going to cost me $751 after tax. Well, isn't that 1,000 minus 249? Cost me 1,000 before tax, 249 with the tax saving, therefore 751. So rather than doing all of this work, we can simply use that formula. We're going to keep the asset for a long period of time. Now, if I go back to this algorithm here, if I'm keeping an asset for a very long period of time, if I want to calculate the tax savings, I can simply use CCTF, and I'm done. Okay. But if I'm keeping it for a short period of time, like in a project analysis, let's say we've got a 4-year project with a 4-year economic life. Well, this number is going to be not a very good approximation because it might be the same 10 years out or so. In this case, I actually have to calculate each year. To figure out what are the explicit tax savings in those 4 years, because that's what's relevant to the project. We'll talk about what happens at the end of the project from a tax point of view a little later. So if I have to, life is easy if you keep it for a long time, tax savings is that. If it's a specific project, then you have to go down this branch of the tree and essentially calculate for depreciation charges. Okay. We'll show you a shortcut a little later. Okay. This is really a geometric series with minus p change in actual each year. And we'll show you that when we pull everything. Okay. So again, you got an expenditure, decide whether it's expense or capital. If it's expense, you know what to do. If it's capital, you need to depreciate it. If it's a long-term asset, CCTF will get you there very quickly. If it's a specific planning period, which is much shorter than infinity, then you have to calculate them year by year. Okay. And then just add to your cash flows. Okay. So that's essentially the algorithm for dealing with cash flows from an expense point of view. Now, if I want to now come up with what is the impact on the bottom line of operating this project that has a capital asset, 2 components. Net operating income and tax savings due to the equipment. And so, where am I going to write this? Let me write this here. And so, if I want to now look at the after-tax cash flow total of operating a project that has equipment, well, the first one is from operating, right? Revenue minus expenses 1 minus T. And let me do this for every year K. So revenue in K, they may be different each year. Expenses may be different. And T assumes to stay the same for the entire project planning period. So that's the cash flow from operating. But now don't I have some savings because I've got a piece of equipment in this project? And what are those savings? Well, this we calculate it by explicitly figuring out for each year of the project what is the depreciation. So if I add this, DTSK, I'm done. So for every year of the project, we want to evaluate this equation. Right, there'll be enough information that'll tell you about revenue, expenses, and the nature of the capital asset being used. We'll have to do that. So essentially, all of this information gets put into this equation. Okay, I'll show you an example. You'd like to reach down the road, exactly try to pull it out. Okay. So again, just keep in mind the choice you have to make, and then this number. What about down in the United States? Well, here an asset costs $751 per thousand, whereas in the United States I suggested to you depreciation was faster. Depreciation being faster means tax savings are greater. And all this does is look at having an asset, and remember in the States you get to write it off fully over 6 years. It's a 5-year asset. Go back to this network router we were talking about. The tax savings are greater in the States, 276 versus the 249 here. So in the United States, all other things being equal, locating an asset down there is cheaper. Okay. So the after-tax cost, well, 1,000 minus the tax savings, so 724. Okay. Casper, the problem set 3 talks a little bit about this in terms of a project to locate something here 4 times. Okay. So slightly different method, but basically the same. You're taking your first cost, you're spreading that out over time, and you're making the company wait for the depreciation tax savings basically along the same lifetime of the asset itself. Okay, that's the whole, and every jurisdiction has slightly different rules, but it's basically that premise. Any questions? Okay. Okay, well let's go back to my introductory discussion as to how does this income tax act affect our engineering design. And I suggested to you that when we looked at this telephone switch, that if we designed it properly in full knowledge of the Income Tax Act, we could flow out lots of tax savings to our customers. If we didn't, suggest that we go out of business because no one would buy from us. Well, let's say the company keeps these telephone switches for a very long time. So, we're manufacturing them, we sell them to a company, the company uses it to provide telephone service and make money. If we sold it simply as a switch, okay, and if I go back and just to remind you to the depreciation schedule, we had a choice in terms of how we manufacture the switch. In terms of simply calling it a switch, in which case it's class 17, so it's a telephone switch, and you only get 8%. Well, 8% takes an awful long time to get your tax savings depreciation. Or we could recognize that a stored program machine, and whether it's a telephone switch or a manufacturing device or a circuit board, stuffer, or whatever, is hardware and software. We could break up the components of that into what their value, the respective components are in terms of their value, and flow out faster tax savings if we can establish the value for the software. In this case, the actual value for the hardware itself that wasn't, the value of software operating system versus application. Application software being, of course, the most generous in terms of tax savings. And so if we sold it as a switch, it would be 8%, very high cost in terms of after-tax cost of the asset. If we broke it up into operating system software, application software, and actual telephone hardware, we could use much higher depreciation and save money. That slide that I started with shows you how that works on the assumption that the telephone company keeps the switch for a long time. If the telephone company keeps the switch for a long time, we can go down and use the capital cost tax bracket. And if we do that, we'll just demonstrate that indeed that simple design change, where rather than storing all of the programs in read-only memory in the machine, basically making it application software that gets loaded in, generates considerable value. The after-tax cost of a $10 million switch, as a switch, is $8.3 million. Break it up into software and hardware, and all of a sudden, you've got a huge amount of savings, almost $900,000 after tax. Where does that come from? Well, the fact that half of the value of the machine can be depreciated at either 20 or 100%. So, the after-tax cost, which is what the customer is looking at, is $7.4 million. It's a huge difference. So, in engineering design, we have to be aware of these sorts of things and structure our projects so that our customers can indeed take advantage of this. So it does make a very significant difference. Okay. Now, I want to now talk a little bit about the end of the project. Okay. So we've talked about buying the asset, capital expenditure, depreciating it over the life of the asset. Then we're talking about the actual net operating income, what happens each year. And now we have to talk a little bit about, at the end of the project, what needs to happen. Well, at the end of the project, generally, we're at the economic life of the asset, and so we're going to get rid of it. What are the tax consequences associated with that? And we need to just touch on that a little bit. Now, capital cost allowance is a way of flowing out the cost associated with operating a machine in terms of making it an expense, right? Because depreciation is an expense. If we take too much, then what we're saying is that the rules have basically depreciated the asset far too quickly, okay, compared to the market value. And therefore, in a sense, we've taken too much depreciation, and that tax depreciation doesn't represent the loss of value. That's what recaptured capital cost allowance is all about. The government wants it back. Is it illegal to do it? Well, the answer is no. We just follow the rule. If we have a satellite and we're depreciating it 40% a year, well, it's going to be worth next to nothing after 3 or 4 years on the books for tax purposes. But of course, the value, the actual market value of that satellite might indeed be increasing. So when we come to sell it, we've taken all this depreciation, which is perfectly legal, and we sell it for a profit. The government wants to tax us on that profit, and that's what this is about. Now, I want to talk about it not only in terms of the corporate world, but for personal finance in terms of the stock market. And capital gain can rise from having a capital asset or from a financial asset such as the stock. And what happens is, and we've talked about capital gains tax a little bit, how it is treated less harsh a tax than earning income. And so what can happen when I have a capital asset, when I want to sell it? Well, I can sell it for more than I paid for it. Okay. Or I can sell it above book value, or I can sell it at a loss below book value. Okay. And all of these have slightly different treatment. And I'd like to start with number 2 first, because really this is sort of the stock market example. If I buy some shares for $1,000, and let's say I happen to be able to sell them for $1,500, I have made a $500 capital gain. Okay. And it's not like I didn't earn that money, it was just a gain on an asset that I own. Now, the taxation on that is 50%. In other words, 50% of the gain is included as income and taxed at my normal rate. In other words, the rate on capital gains is T over 2. Right? Half the normal tax rate. Now, it used to be different. And back in the old days, 1971 and beyond, before, governments hadn't figured out how to tax everything. They've been working on it every year, right? And so back in the old days, if I made $1 million in the stock market, I would pay 0 tax on it, because capital gains were not taxed in Canada. And remember the principle in Canada of taxation. If you have the ability to pay, you should pay. Well, if I made $1 million in the stock market, clearly I have the ability to pay. So it seems unfair to everyone else who's working for a living and paying taxes that someone making $1 million in the stock market doesn't pay any tax. So in 1971, they recognized that that's unfair and equitable, and therefore half the gain is taxed. Well, why half? Well, you want to encourage people to invest because they're taking a risk. I mean, nothing's certain in the stock market or in any capital asset, and therefore the incentive is that some of the gain isn't taxed. And the government figured, well, half of it not being taxed, half of it being taxed, was enough incentive for people to invest, and investment creates employment as well in the country. Now, as the government became cash-strapped, it decided to tax more and more of the gain. Okay, 2/3 and then 3/4. So of course, the tax rate rather than T/2 is, T times 3/4, 75%. Well, with North American free trade and, investment moving back and forth, we have to be a little more aligned with our cousins down in the United States, and it dropped back to 50% where it is now. So, if we make $1 million in the stock market, 500,000 is tax-free, and you get a normal tax rate on the other half. Well, how does this apply to engineering projects? Well, if we buy an asset and we have to sell it for more than we paid for it, there would be a capital gains tax. That seldom happens. Usually by the time we're finished with the asset, it's not worth very much. So I'm including this for personal finance in terms of what happens for you making money in the stock market. Now, what normally happens is that the value of the asset decreases. Okay? And it can either be above book value or below book value. If it's above book value, essentially, we have, if it's above book value, we basically haven't been allowed to depreciate it quickly enough, okay? But nothing happens. Okay? If we're below book value, like the satellite example, we've depreciated a lot, not representative of loss of value, and the government wants it back. Okay? So that's case number one. And rather than just talking about words here, let me show you the example, and we'll hopefully be clear. Okay. I have an asset with the original cost, so FC in this chart is $10,000. The undepreciated book value, so at some time, B sub T, or B sub K, BV sub K is 2,000. I.e., while I've had it, I have taken a total sum of depreciation of $8,000. So the summation of all the D's, D1 through DK, is 8,000. And I'm being taxed at 40%. At the end of the project, I'm going to sell it, because I don't need it anymore. And what can happen? Well, 4 possibilities. Number one is that I made a capital gain on it. Not very likely in engineering projects, but it's possible. For example, if I'm in the rental business and I have a house, well, a house is a capital asset. Over time, housing prices go up. In that business, when I sell it, I'm likely to have a capital gain. Well, what happens? Well, the first part of it is that the $2,000 capital gain is taxed at 50% of the normal rate. So I've got $2,000 gain, $1,000 is taxable, my tax rate is 40%, so I owe $400. Okay. The difficult part of it is the second part. The book value is at $2,000, which means I have legally been allowed to take $8,000 worth of depreciation and save those taxes. And I've done that D1, D2, up until the time that I'm selling. But remember, depreciation is all about loss of value. And this thing hasn't lost any value. It's actually gained value. So the government says, well, you made money on this, you took depreciation, I want all of that depreciation back. So the $10,000 minus $2,000 is the depreciation the government wants back. It's taxed at 40%, and I owe $3,200. That's what we call depreciation recapture. Now, why does the government allow us to do that? Well, when I buy the thing, I don't know what I'm going to sell it for 10 years from now. And we don't want any estimates in the game. So it's simple. I've got FC, I've got my depreciation rate, and I've got the CCA schedule. I'm just going to do it. Why do I want to do it? Well, I'd rather pay taxes of $3,200 10 years from now, or whenever I sell it, and get those savings all throughout the project life. So it's in my interest to take the maximum depreciation. I'm going to get those savings if I have to pay tax. So if you owe it, the government wants it. Now, if it's the flip side, that the government hasn't allowed you enough depreciation, it's called a terminal loss. That's this case here. So let's say that we've depreciated by $8,000, but its loss of value is $9,000. Well, you think fair is fair in the sense that the government didn't allow me the full depreciation for tax purposes, and I should get a savings of $1,000 times T. Okay. And the tax reduction is $400. However, the government says, well, if there's a terminal loss, we're not going to give you anything. Okay, too bad. If you owe it, you've got to pay it. If they owe you, they say you can't claim a terminal loss. The only time you can, if it's the very last asset in that class, which never happens for going concern. If I basically sell a computer at a terminal loss, well, my company's always going to have computers. I'm never going to have the very last one in the class. So, for most purposes, the only thing that you have to worry about is depreciation recapture. If I'm allowed through a tax incentive program, accelerated depreciation, to depreciate really quickly, then when I sell it, I usually win. So case number 2, this $7,000 one is the one we normally have to worry about. Okay. And generally, we don't make a capital gain unless we're in the real estate business. So this is what happens at the end of the project, where we need to consider all of the things that can happen. Any questions on a fair bit of material? Okay. As I say, I'm going to tie all these points together in a project analysis and a lecture song. Okay. Well, let me talk about the very last aspect of the Income Tax Act, the tax or engineering projects, and then I'll have an example to sort of wrap it up. Okay. Income tax incentives. Well, remember, the reason that the Income Tax Act is as thick as it is simply because the government tries to affect behavior in the marketplace through the Tax Act. So we may not do things if there's no tax incentive, make a tax incentive, and the after-tax cost of the project changes, and our decision may change. There are 2 basic mechanisms. Accelerated capital cost allowance is what we've talked about. Simply have a rate much higher than would normally be the case given the life of the asset. So a satellite normally should be 8 or 10%, but it's 40%. 40% means tax savings occur very, very quickly. That makes the asset much cheaper. So we talked about that. That's pretty straightforward. The other side of things, and this is usually in terms of where you locate in the country. Again, governments want to encourage disadvantaged areas to have more industry, so that there's employment and wealth being generated. And this is what investment tax credits are about. Also using different types of technology. Basically, you have a qualifying investment, and you're allowed a certain percentage of that as a tax credit. Okay. And as a tax credit, it's just a direct application to tax you have to pay up once. There are a number of programs that are available in Canada, and they all are very, very specific in terms of what you need to do. They have rules. They're all in the book, in language that's hard to understand. So oftentimes there's a whole sort of sub-industry out there in terms of advising industry on how to maximize the investment tax credits. But you have to structure things correctly to get the maximum tax benefit. So usually you get professional advice when you're looking at doing these things, setting up a project. Some examples might be program for export market development. Well, if you can export from Canada, you're generating wealth and employment in the country. But it's oftentimes very difficult to break it into a marketplace because you've got various tax regulations, you've got various packaging regulations, language regulations, standards, and what have you. And large companies can afford consultants to basically look at their product that they sell in Canada and figure out how to market, let's say, in the UK. It's very costly. But small companies can't. Small companies generate a lot of employment. So the government said, well, if a small company, which is defined by the amount of revenue they have per year, wants to export, we will help pay a very substantial portion of the fees associated with that export market development. So all the consultants' fees basically would be subsidized by the government for a small company to figure out how to export their product to a different country. In parts of the country where technology, let's say where there's old industry, and there's a desire to put new technology programs in place, manufacturing circuit boards or cell phones or what have you. New technology employment program says that if you take someone that's been displaced from an industry that's aging and hire them into a qualifying type of high technology industry, we're going to pay half their wages for the next 2 or 3 years. So all of a sudden, if you do what they say and locate, let's say, in Cape Breton Island, half your wage bill is picked up by the taxpayer. That certainly changes the economics of a project you may decide to go with. So all of these incentives affect the after-tax cash flow. So we'll have it, we'll do an analysis based on this, doing it, let's say, in Central Ontario, where there's no tax incentive, and then all of a sudden, you'll look at it, and you'll have ITC, hey, an investment tax credit, which will directly flow to your bottom line after-tax cash flow. And that may be enough to change the project. And so the rankings of the project may be significantly different. That's what the government's after. pretty much do things the way that they want. Now, I want to give you an example. And first of all, we'll just show it the calculation. This is a correction of something in the textbook which is wrong. It's just arithmetic. If I have a qualifying asset, okay, and let's say I locate it in a part of the country where the government wants me to, I'm going to get 7% investment tax credit. If I locate it in Ontario, I get nothing. And so, take this 1.7 million, and all of a sudden I've got a $119,000 tax credit available to me. I wouldn't have it if I located it in Ontario. Now, oftentimes there's rules in terms of how quickly this flows out to the actual company. And oftentimes it's skewed so that small companies get all of the money up front, and larger companies have to wait. Okay? And this is sort of in that sort of light in terms of this rule. So, you get the 119 tax credit, and you can use all of the tax liability for the first $15,000. So small companies pay a little bit of tax. They basically have all their tax wiped out. And then it flows out 50% in excess. So in the first year, well, we get the 15, and then we have, let's say, a tax liability in this company of $200,000. So we have a $200,000 tax bill. If we locate it in Ontario, we pay $200,000. That's it. Locate wherever, get your investment tax credit, and you get a tax credit of $107,000. So rather than paying $200,000, you're paying $93,000. Okay. Then, of course, you've still got a little bit left over. 119 was your tax credit, 107 you were allowed to use in the first year, and so I'm left with 11.5. Next year, I'm going to have those tax savings. So, in terms of D1, ITC1 would be 107.5, and ITC2 would be 11.5. Direct cash flow because it's money that we would have spent on taxes otherwise. Okay, and so the cash flow is adjusted. Now, I'd like to show you an application of this. And it's an example out in Nova Scotia where a company was looking at buying a supercomputer and selling the time on that supercomputer and, of course, trying to make some money. Supercomputer, very, very expensive computer, very, very specialized, and there's only certain types of problems where it's worthwhile. If I have a problem where I need, it's very, very numerically intensive, and I need the answer right away, like within an hour or two, then I might buy time on a supercomputer. But if I can wait 3 weeks or 4 weeks for the answer, I can just run that calculation in the background on computers that I have and get it for free. Okay. And so oftentimes if you're on a design team and you're doing these modeling and you need to get answers and get your design done, you're going to buy time on a supercomputer. But they're very expensive. And so this company was looking at creating a supercomputer business with specifically that in mind. The University of Toronto at the same time bought a supercomputer, and we had the same model. We wanted to find people in Central Ontario who were willing to pay $500 an hour to use this machine, and help pay for the machine so our researchers could use it for $50 an hour. So it was a subsidized model where we hoped to sell time outside at very, very large rates, market rates, to subsidize the cost of the machine for our own needs. Okay, and you can see how that worked out, not so well in a little bit. So essentially, they're going to locate either where all the customers are, like U of T, in Central Ontario, or they've heard about this very, very lucrative incentive program called Enterprise Cape Breton, where if they locate a piece of technology like this out there, there's huge tax savings. And so what I'd like to do is to look at the decision and see where they actually would locate, and then perhaps talk about, well, is this really in the public interest? Okay. So, first part of this talks a little bit about the analysis and looks at the two options. The first option, locating in let's say Central Ontario, has a net present value cost of minus $7.4 million before we consider depreciation and tax savings on the investment tax credit. So think about this. It's a 4-year project, supercomputers, very, very expensive. I have revenues for 4 years, hopefully. I have costs for 4 years. And then I'm going to sell the machine 4 years from now. So the engineers have done this analysis and have come up with NPV minus $7.4 million. Okay. Now, if you locate out in Cape Breton Island, well, none of your customers are there, so you're going to have extra telecom costs, you're going to have extra marketing costs, travel costs, and what have you. So your costs might go up. And it would be, so this is in Central Ontario, NPV CBI is going to be minus 7.8 million, reflecting that it's much more costly to locate there. Okay. But if you locate in Cape Breton Island, you've got this tax credit system that's going to work for you. Okay. Now, the way that the investment tax credit works is that when you make the investment, 20% of the eligible hardware is subject to the tax credit. So if this is a $30 million machine, there's a very large tax credit waiting for you if you locate in Cape Breton Island. You get nothing if you locate in Ontario. Okay. Supercomputer is electronic data processing equipment, so it's class 10, 30%. 33 million is what they pay, and their tax rate is 40%. For the time being, we're going to assume that they're profitable. Okay, so they're part of a big company, or they're getting enough revenue to be profitable. So those numbers are without any income tax savings due to depreciation. So let's see how this analysis plays out. Okay. It's a standard capital cost allowance in Canada calculation. In Ontario, it's truly standard in the sense that they've got $33 million worth of purchase. I have the half euro playing out, and I have a 30% tax rate. Excuse me, 40% tax rate. It's a risky project, so I happen to be using 30% as my discount rate. It's probably pretty high, too high. Okay. Anyway, the formulas that I have on the blackboard, okay, it's a capital asset, therefore we have to depreciate it. And I'm going to come up with a set of tax savings. Okay. Present value 1.5 to 11.6. At the end of the project, I have a salvage value, which is next to nothing. Those machines become obsolete very, very quickly, and therefore over 4 years you can expect it not to be worth anything. U of T bought a machine for $15 million, which was used through NASA. 4 years later, we sold it for $25,000. It was just scrap value. So next to nothing. And what we're going to do in this company is set up a shell company, so it'll be the last computer that we have, so that we'll actually be able to make the terminal loss. So, tax savings in Ontario, $6.5 million. Now think about Cape Breton Island. Well, we can get a 20% tax credit immediately, so $6.6 million. And the government says, well, if we're paying for part of the machine, we're not going to allow you to depreciate the part that we paid for. So in those rules that I initially introduced for CCA, you reduce the book value by the tax credit. So buy it for $33 million, get 6.6 tax credit, 26.4 is the part that the company's paying for, and the part that they get to depreciate. And standard CCA analysis. And at the end, the book value is 7.7, and the terminal loss. Huge difference in tax credits. In tax savings, 11.8 versus 6.5. And so all we're doing here is, in addition to the operating cash flows, because this is operating, well, this is operating, trying to figure out this part here. So all of this has been done for you. That's the 7.4 and 7.8. And all we're doing is trying to figure out this and this in addition to that. Well, let's have a look at the cash flows. So we've got, in addition to the operating cash flows, in Ontario, your standard CCA tax savings. And because we're going to wrap the company up after 4 years, the supercomputer is the last computer it has, therefore we can take the terminal loss. In Cape Breton Island, the depreciation charges are smaller simply because we get that huge tax credit. So what's the decision? Well, if it's a purely economic decision in the absence of any income tax incentives, we would not go ahead with this project in central Canada simply because the net present value is minus $1 million. There isn't enough revenue, as U of T discovered when we bought our supercomputer, there isn't enough revenue to support this sort of machine in Canada. Okay. And so you wouldn't do it in central Ontario. Therefore, in the absence of investment tax credits, you wouldn't do it in Cape Breton Island because it's more expensive. $400,000 net present value more expensive. So this is a project that's dead. But the government, and it doesn't really think about supercomputers, it just has this program, and this happens to be eligible because it's a computer, says, we will now make this project worthwhile. It's now, with the tax credits, worth $4 million. And this company doesn't care whether it gets its money from its customers, providing real value, or whether it gets its money from the government. It's a $4 million good project. So Enterprise Cape Breton has, actually $4 million is not right, it's generated actually $4.9 million worth of value. It's turned something that wasn't worth doing into something that's worth doing. And of course, go on that basis. Now this is loosely based on a company called Magna International, Magna Aerospace International, that actually did this. Not very successfully. Essentially, they bought their machine, they went out to Cape Breton Island, they couldn't find enough customers. And essentially they got behind on their payments. And so they got into trouble with Control Data, who actually sold these machines. Now, that wasn't the half of it. They also got into trouble with the Canada Revenue Agency. As I mentioned, this is sort of part of the law, right? And you have to follow it to the letter. And the law says, basically, the tax credit is based on hardware. Okay. Well, the hardware declared value was $33 million. The reason I mentioned U of T is at the time they bought a better machine for $13 million. And they claimed it was $33 million. Well, when RCMP had a look, what they found was that the company that's selling it, Control Data, basically sold them a package for $33 million. So they said, maintenance is going to be free for 4 years. Software is going to be free. Support services, consulting, all of these things are free. And the value of the machine is $33 million. Well, the tax credit is based on the value of the machine. Is that a legitimate business transaction? Does anyone maintain a machine for free or consult for free? Yeah, the answer is absolutely not. So the way this was structured was to inflate the hardware cost so that it would maximize the tax savings, which was not legitimate. The other problem was they weren't making any money. Remember, these tax credits were of very little value. There was an upfront credit on the basis of them making money, but essentially it was a real problem. This thing sort of died. And my observation really is that these sorts of things generally don't work. And there is employment being generated, but to me the only employment that's being generated is really in the local detachment of the RCMP, in their fraud squad, as well as additional auditors for Revenue Canada. Seems to be, in this case at least, the only extra employment that is generated. And I have an article which will just sum it up, so I got to wrap up here, is that economists don't like these sorts of things simply because it's not neutral. These are things that companies would not otherwise do. And so this program, the most lucrative in the country, Enterprise Cape Breton, has funded all sorts of things. I'll just leave you to read these things. Cell phone companies that got millions of dollars but never even started. Okay. Other companies that got loans that were backed by Enterprise Cape Breton, and when they defaulted, of course, the taxpayer in Enterprise Cape Breton had to fix them. So many of these, while it's laudable to try to create value in parts of the country that are not getting their fair share of the economic pie, it doesn't seem to work. It's a very large expense to the taxpayer. Well, I'll leave you to decide whether you want your tax dollars going into things like this. Okay. Anyway, next day I'm going to tie all these things together and we'll do a project analysis and show you exactly how to basically work that equation. Thank you.
对呀，一会儿觉不觉得是第二？不过没什么好说的。就是 BA 3楼 lab， 我们都在呢。我们都在呢。